We're almost at the end of the year. We have got only 3 more days left to the trading year. And so far, the S&P 500 is up 23%. So I'm sure that some of you have got positive gains in your portfolio. Some of you could even be beating the S&P by a wide margin. But some of you may have missed out on those gains. And some of you may have stayed in cash and have gotten much lower returns. Some of you may have shorted the market and gotten negative returns. But the most important thing is not how much you made this year, although, yeah, that's important. But I think the most important thing is, what did you learn? What did you learn about the market? What did you learn about yourself? Because that's even more important, because that will determine your returns for future years. Remember that success comes from having good judgment, but good judgment comes from having experience. And experience comes from having previous bad judgments that you learn from. But if you have got bad judgments in the past that you don't learn from, and you don't take ownership of those bad judgments, and you blame everyone, you blame your luck, you blame God, you blame the market, you blame the broker, you blame the guru, then you don't learn anything. But if you take responsibility and ask yourself this question, what can I learn from it? How can this make me a better investor and better trader? Then that leads to experience. And experience will lead to future good judgments in the years to come, and that will lead to even greater success in the years ahead. All right. So I'm here to share what are my main takeaways for 2023, but I do hope that you will share what are your lessons as well in the comment section below. I'd love to hear what you have to say as well. But before we go into that, a lot of people, they think that, wow, up 23% is a pretty unusual year for the S&P 500. But if you take a look at history, actually it is not. A 20+% return in the S&P 500 is actually one of the most common outcomes of the US market, especially after a previous down year. If you take a look at this chart over here, you can see this is a distribution of returns across all the years over the last 96 years. And you can see that out of the last 96 years, 23% of those years, of which this year is one of them, okay, the market gained 20 to 30%. So market gaining 20 to 30% in 1 year is actually the most common outcome of all the possible outcomes. And of course, a lot of people were calling for a crash this year. Some were saying the market's going to crash 20, 30%. Could it happen? Of course, it could happen. But what's the probability of that happening? It is actually very rare. You can see that the chance of the market dropping 20 to 30% in a year, it only happened 3 times in 96 years. It's only a 3.2% probability. So if you're shorting the market, betting on the crash, your chance of being right is only 3%, okay? And even if you are betting on a decline of, say, 10 to 20%, again, your chance of being right is only like 4%. But if you bet that the market would gain 10, 20, 30% this year, then your odds of being right are actually 23% plus 18.9% plus 18.9%. This is a probability that the market will gain anywhere from 10 to 20 or 30%. If you add these 3 percentages together, that is about like more than 50% probability, right? So something to think about, okay? So with that, let me go on to, I think, some of the important lessons to take away for this year. Lesson number 1, I'm sure you guys would have seen this coming. I've said this many, many times, but I have to reinforce it again because it's such an important lesson. Lesson number 1 is, don't ever listen to the predictions of economists and market so-called analysts and experts. At the end of last year and the beginning of this year, the majority of economists called for a recession this year. The majority of market experts called for another crash, or they just said it's a bear market rally, right? So I'm sure you've seen this. End of last year, The Economist, a reputable magazine, said why a global recession is inevitable in 2023. In fact, if I'm not wrong, Bloomberg, they also had an article that said that a recession was 100% probability in 2023. Not 90%, but 100%. Okay? And then you've got all these market analysts and gurus. Jeremy Grantham said that the market's going to plunge 50% this year. Deutsche Bank said that the market's going to plunge 25% this year. And this other person, Chris Vermeulen, said that stock markets are going to crash 37% this year. And it's a suckers rally that's going to end. Now, some of you may be thinking, Adam, if I don't listen to these experts, these economists, these analysts, then who do I listen to? The answer is no one. Don't listen to anyone. Instead, follow your investment plan. If you are an investor and if you're a short-term trader, follow your trading plan. So for example, as an investor, you got to have a plan. Like my plan as an investor is to only buy fundamentally great companies that meet my 7-step criteria. Companies that have consistent growth in revenue, profits, and free cash flow. Companies that have got high return on capital. Companies that have got conservative debt. Companies that have got a sustainable competitive advantage. So I identify these companies every single year. And once I calculate the intrinsic value, I know what the shares are worth. And once the price is below that intrinsic value, and at a support level, I just add shares. And that's all I do. So my decision to buy shares of a good company have got nothing to do with any kind of market or economic predictions. It's got to do with, is it a good company? Is it undervalued? Has it retraced to a technical support level? If it is, I just add shares, because I know that if I do that over time, the shares of the company will be a lot higher over time. As a trader, I trade options, as you guys know, and I trade purely based on the price action. So for example, if I'm going to go long using options, I want to ensure that it's a clear uptrend. I want to see higher highs and higher lows. I want to see the price retracing to a strong level of support. Then I go long on my option strategy. Or if it's a reversal strategy, I want to see that the stock has dropped to a strong level of support where the stochastics are oversold, Bollinger Bands are oversold. I see a double bottom pattern. Once I see those entry signals, I enter with a long trade. And of course, in trading, you can't win all the time. You've got winning trades, you have losing trades. That's trading, but you win a lot more when you win and you lose a lot less when you lose. That's all about risk to reward ratios. And by following the trading plan, I generate consistent profits in my trades. By following my investment plan, I build my wealth consistently over time. It's got nothing to do with predictions. So remember, follow your investment plan, follow your trading plan, your predetermined entry rules, exit rules, risk management rules, and do not follow any kind of predictions, no matter who gives those predictions, even me. If I give you a prediction, ignore me. Follow your investment and trading plan. Because I can tell you that even when I make predictions, I don't follow my own predictions. I just follow my investment and trading plan. I just make predictions for entertainment purposes only. All right, so that's lesson number 1. Lesson number 2, don't argue with the market. Follow the price action of the market, follow the trend. So whether you are an investor or trader, same thing. Especially if you're a trader. If you're a trader, when do you want to go long? When it's on an uptrend. On an uptrend, you want to go long. You don't want to fight the trend. You don't want to go against the wind, right? If it's on a downtrend, then you go short. You always follow the trend. Now, as an investor, of course, the trends are not as important, but important as well. So for example, as an investor, if you find a great company and it's undervalued, but it's still on a downtrend, you may want to wait before adding shares. Wait for the downtrend to show signs of a reversal, like a double bottom pattern or oversold pattern, right? Or wait for the downtrend to consolidate, and then you buy during the consolidation process at the support levels before the uptrend resumes. Or you could wait for the downtrend to confirm into an uptrend before you enter. So again, whether you're an investor or trader, you got to use the trends and the reversals to make smart decisions. And what amazes me is that there were people I saw on social media shorting the market all the way till the last few weeks. Are they freaking insane? How can you short and go against an uptrend? That's effing stupid, okay? Now, what's the definition of an uptrend? An uptrend definition is higher highs and higher lows. That's a textbook definition. Now, you can see, for example, Now, this was obviously a downtrend, right? Because you can see lower highs and lower lows. Sure, at that time, if you want to short the market, go ahead, right? But once the market makes higher highs and higher lows, right? You can see higher highs, higher highs, higher highs, higher highs, right? Higher lows. This confirmed the uptrend based on the higher highs, higher lows. So the moment you know it's an uptrend, you don't want to short, right? But there are people who are shorting all the way. They're freaking insane, right? You want to either not short or follow the trend and go long. Now, if you find it hard to read these higher highs and higher lows, look at the moving averages. Now, those of you who have been following my technical analysis lessons, I've shared them freely on YouTube as well and in my courses. I shared with you, simply look at the moving averages, the 50 and 150 moving average. By the way, this technique was not invented by me. I'm not that smart, okay? I learned it from this guy called Victor Sperandio, who wrote a book many years ago. I think it was like 25 years ago. And it was from his book that I learned this technique. The name of the book is called Methods of a Wall Street Master. And this one simple technique that I learned from Victor Sperandio was life-changing, right? It really made a big difference in the way I traded and invested. So again, I don't take any credit. This comes from Victor Sperandio, okay, who is one of the top Wall Street masters. And what I learned from Victor Sperandio is that when the 50 moving average, which is the blue line, all right, and this on daily candles, by the way, when the 50 moving average is below the 150 and is sloping down, it's a downtrend, okay? When the 50 moving average crosses above the 150 moving average, which means the blue line crosses above the green line, and the two moving averages start flattening and sloping up, it's got to be confirmed by the slope, right? If they slope down, it is not an uptrend. They have to be flat or sloping up. The crossover, that confirms the bull market. So if you guys remember, I released a video in March of this year saying that the bull market began, right? Now, why did I say that? Because of the moving average crossover signal. You can see over there, when the 50 crosses above the 150 and the blue is sloping up, green is sloping up, that confirms the bull market, right? Now again, is it 100% when that happens to the bull market? No, it's not 100%. But if you backtest this technique, backtest it 20, 30, 50 years, it's got over 90% accuracy. That when you see this crossover, 90% of the time, we're in a new bull market, we're in a new uptrend, all right? So that's another way you can tell. By the way, what's the definition of a bull market? I also find it insane that till today, you still have people who are saying, it's not a bull market, it's a bear market. I mean, are they effing stupid? What's the definition of a bull market? Go read it up, okay? The definition of a bull market is when stock prices close 20% above the low. That's a bull market definition. So that was the low last year, October 2022. When did the market close 20% above that? It happened about there, right? So this here was the official bull market definition. But of course, I didn't wait for that to happen. My 5150 signal gave me the bull market signal a lot earlier. Now, some of you may say, but Adam, isn't this a downtrend signal where the 50 moving average crossed below the 150 moving average? No, because the 150 moving average is still sloping upwards, as you can see, right? On an uptrend, when both moving averages, as long as one of them is still sloping upwards, it is not a downtrend yet, all right? So although the 50 crossed below the 150, the 150, the green line, continued to slope up, so this was not a downtrend signal, all right? Now remember that in a bull market and on an uptrend, prices don't go up every day, every week, or even every month. You do have pullbacks and corrections along that bull market. And this was what we call a pullback. That's a pullback. That's a correction. You say, what's the difference? Okay. A pullback is usually less than 10% drop. A correction is usually more than 10%, but less than 20%. Okay, because more than 20%, ooh, new bear market, right? Okay, so right now we've got this strong wave up going into the end of the year. And are we still in a bull market? Of course, we're in a bull market, right? But of course, we are a bit overextended, right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up. Okay, so don't be surprised that especially at the start of next year, we will probably have a wave down, right? We go a bit high and then we will wave down, right? There'll be a great opportunity for me to go and buy more and then wave up again, okay? Until the bull market ends, which I don't think is going to end very soon because we just started a bull market and next year is the second year of the bull market. On average, bull markets last at least 5 years, but in my opinion, I think that this bull market is going to last a lot longer. But again, that's a prediction. Don't listen to predictions. Follow the trend. Follow your investment and trading plan, okay? So again, people who now still say that it's a bear market are freaking delusional. It's like people who are saying the earth is flat. Come on. Okay. The definition is a bull market is 20% above the lows. It's like that. It's kind of like the definition of a spider is an insect with 8 legs. So, people who say it's still a bear market, it's like looking at a spider and saying it's not a spider. It's an ant. Right? I mean, that's freaking stupid, right? So don't be freaking stupid. Follow the definition, follow the trend, okay? Now again, take a look at this. You can see that as we were in this uptrend pattern, see in retrospect is really clear, right? You go wave up, wave down, wave up, wave down, wave up, wave down, wave up. It's a very textbook uptrend. But again, look at all these bearish predictions and all these people telling you to short the market or to get off the market. You need to ignore all these things and just follow the trend, follow the price action. I remember that in 2020 and 2021, as the stock market kept going up, people were saying the only reason the market is going up is because the Federal Reserve is printing money, doing quantitative easing. And then when the Federal Reserve started to do quantitative tightening, that means they no longer printed money. In fact, they were doing quantitative tightening, which means they were reducing the money supply. A lot of bears were saying there's no way the stock market can go up this year because the money supply is dropping. But what happened? The money supply has been falling off a cliff, but the stock market is still going up. So, bam, that's wrong, right? So lesson number 3, remember that ultimately what drives stock prices higher is not just money supply. In fact, money supply is just one of the many factors, and it's not the most important factor. The most important thing that drives stock prices higher would be earnings growth. Now, ultimately, remember, what are stocks? Stocks are pieces of businesses. What's a business? A business is a money-making machine. McDonald's is a money-making machine. Apple's a money-making machine. Visa is a money-making machine. The more money they make, the more profits they generate, the more they are worth. It's as simple as that. So as long as profits are growing over time, businesses will get more and more valuable and share prices will go up, even if money supply doesn't go up. So all about earnings growth. So that's the reason why in the long run, the stock market will always go up because corporate earnings will always grow over the long run. In fact, historically, corporate earnings grow at about 8% a year. But why is it the S&P 500 grows more than 8% a year? Because besides earnings growth, the stock prices are also driven up by share buybacks. And of course, to an extent, money supply as well, right? But ultimately, it is earnings growth. And one of the reasons why I'm pretty optimistic that the market will continue going higher next year is because I expect earnings to continue to grow next year. We had an earnings recession early this year and late last year. So quarter 4, 2022, quarter 1, quarter 2, 2023, we had an earnings recession. Earnings turned negative growth. Then in quarter 3 of this year, earnings started growing again. So we have already bottomed and now earnings are beginning to grow into the next year. So that should drive stock prices higher. even if the Fed doesn't cut rates, even if the Fed doesn't increase the money supply. All right. Now, I'm sure you've heard that this year's bull market was only driven by a few stocks. The Magnificent Seven, your Amazon, your Meta, your Alphabet, your Tesla, your Nvidia, your Microsoft, your Google. These Magnificent Seven stocks are up 71% as of November, whereas the rest of the stocks of the S&P 500, so 500 minus 7 would be 493 stocks. The rest of the remaining stocks are only up 6%. So the bulk of the gains of the S&P 500 are driven by these 7 companies. Now, this is not something that is entirely rare. It has happened many times in the past where a few companies drive the overall returns in the market. In fact, on an average year, is the top 25% of stocks in the market that account for 100% of all the gains. And 75% of the stocks in the market actually had no gains or made losses. So why are these 7 stocks outperforming all the other companies? For a very simple reason, because these are the highest quality companies that are immune to higher interest rates. No matter how high interest rates go, these companies are immune to it because they've got solid balance sheets, they've got conservatively very low debt, and they've got very predictable revenue, profits, and free cash flow. So they deserve to keep going up. Whereas a lot of the other companies, they are not as predictable. They are harmed by high interest rates. They are affected by fears of recession. So one of the reasons why my portfolio managed to gain over 40% this year is because I own 6 out of 7 of those Magnificent 7 stocks, as well as some other great companies. And investors who underperformed the market this year or made losses this year is because they avoided many of these high-performing companies because to them they thought, oh, it's so expensive, the PE ratio is so high, and they went to buy all the stocks with those very, very low PE ratios. So one of the lessons that I want to bring across is that, a lot of investors make the mistake of prioritizing buying cheap companies. They think that being a good value investor means you buy very cheap companies with low PE ratios. No. Being a great value investor means that the first priority, you must only buy high quality companies that are very predictable, that are very resilient, that are very consistent, that can grow their revenues, profits, and free cash flow regardless of the economic situation. Whether is it high inflation, high interest rate, low interest rate, they can keep growing. These are the highest quality companies. And it's better to own a very high quality company and pay a fair price to it. Of course, don't pay it too expensive. You still want to buy it when it's fairly priced, rather than going for all the cheap stocks that look so cheap, the low PE ratios, but are low quality companies. So always remember, quality over just buying something that is cheap. That's a very, very important thing because when the market gets into a crisis, you find that companies that are not high quality, they will just collapse. But the high quality companies will keep going up even though they may not be cheap anymore. Lesson number 5. Shorting seems glamorous, but it doesn't pay the bills. When I go on social media, I see so many people, especially new novice traders who have lost so much money by trying to short the market, by trying to bet against the market. And I can understand because I used to do this last time. In my younger years, I used to love shorting as well. I used to love to short stocks more than going long stocks because for some reason shorting sounds very glamorous, like you're going against everyone else. You know something that's so special, you're more intelligent, especially after watching movies like The Big Short, right? So it sounds really sexy, you're shorting. But the reason why I hardly ever short anymore, in fact, I didn't short at all this year, is because I've learned over the years that shorting is a losing game over the long run. It just doesn't pay the bills. Now, if you just take a look, for example, at the last 5 years, these are the net gains and losses of short sellers. Yes, short sellers can make money when the market goes down. But the problem is, statistically, the market doesn't go down that often as compared to it going up. And you can see, for example, short sellers, they made money in 2018 when the market took a dive, but they lost it all and more in 2019 when the market recovered. And they lost a lot in 2020 when the bear market lasted only 1 month, it rebounded and their short profits got destroyed. 2021, they lost money again. And of course, 2022, when the market plunged last year, they say, oh yeah, I was right, But guess what? This year, everything they made, they lost it again, or they lost almost everything. So net, if you take a look over a longer term period, over a 5-year period or more, you find that it's almost impossible to make money shorting the market. And the very simple reason is you're going against the odds. It's like pissing against the wind. You just get urine on your face, right? Because remember this chart I showed you? That over 96 years, if you look at history, 74 years were bullish. That's 77% of the time. And 22 years were bearish. That's 23% of the time. So remember, every time you're shorting the market, your odds of being right are 23%. And every time you're long the market, your odds of being right are 77%. And I don't know about you, but I like the odds to be in my favor and not to be going against the odds. Lesson number 6, and to me, this is one of the most important lessons, which is diversification. Proper diversification of your portfolio and portfolio allocation makes a huge difference to your returns at the end of the day. Diversification is very underrated in the markets, but it's extremely important. Like as many of you know, I made some boo-boos this year as well. I've got some of the stocks in my portfolio that did not perform really well. Like for example, I own Disney, that was down a lot this year. I own Estee Lauder, that was down a lot this year. I also own Boston Beer, that was down as well this year. And not to say all my China stocks that are all down as well. But my portfolio, despite all those stocks underperforming, my portfolio is still up as of now 43.75%. The one in blue outperforming the S&P 500. Why? Because my allocation to all those companies were small allocations. And those stocks that I own, like Amazon and Meta and Nvidia and Google, they way outperform. So their way outperformance made up for the underperformance of those stocks, and I still get a very healthy gain beating the market. Now, but I also know people who also own Alibaba like me. They own Disney like me. They own Estee Lauder like me, but they are down for the year. Why? Because they allocated too much to those stocks and they didn't allocate enough to those winning stocks. So let me share with you what are some of the rules that I follow that keep me safe in the markets. So my first rule is this, is to divide your capital equally when you're buying, right? So for example, if you intend to have 20 stocks in your portfolio, then you divide your capital by 20 equally as far as possible. So which means each stock should have a 5% allocation. Okay, so for example, you buy 5% of Disney, 5% of Nvidia, 5% of Meta, right? 5% of each one. Because at the end of the day, you don't know which is going to be the big winner. It's really hard to predict until after it happens, and which ones are going to be the ones underperforming. You don't know, right? So when you first buy, you want to buy in equal proportions. And for the ones that take off, the ones that really do well, like Nvidia, that's up like few 100%, one of the things I learned is that don't cut the flowers. Let your winners run. So initially you put in 5% allocation, but if it doubles and doubles, it becomes 10, 15% of your portfolio. And it's very tempting to sell it, to take the cash to buy more of the rest that went down. Don't do that. Don't cut the flowers and water the weeds. Let your winners run. So if you look at my portfolio right now, you'll notice that some of my stocks like Meta, like Microsoft, like Salesforce, like Google, they have got very big positions in my portfolio. When I first bought them, they were a normal position, but they organically grew to huge positions. That as long as they are great companies, as long as they are not too overpriced, as long as they are growing, I keep them in my portfolio and they drive the gains in my portfolio. Got it? Now, on the other hand, I also allocate, for example, 5% to Disney and 5% to Estee Lauder, so on and so forth. But when they start going down, right? From 5%, the share price drops and it drops to 3% and 2%, for example. Do I buy more to bring it back to 5%? I don't. I do not add more to bring it back to 5%. I let it drop organically. Does this make sense? So by doing that, by letting your winners run and keeping your losers small and not feeding more to your losers, you find that the gains will outweigh the losing investments in the short term, and your portfolio will compound over time. This is not what a lot of fund managers do. In fact, a lot of fund managers, they do portfolio rebalancing, which I think is not a very good idea. Portfolio rebalancing means those stocks that did very well, that are now a big allocation, they sell it and they take the cash and they buy those stocks that went down to bring up the allocation to rebalance it. In theory, it sounds good, but in reality, it causes your portfolio to underperform because again, you're cutting the flowers and watering the weeds and causes underperformance, right? So those are 6 lessons I thought I'll share with you about what we can learn from the markets this year. I'm sure you've got a lot more of your own lessons and do hope that you will share them in your comment section and let's have a constructive and active discussion. Thank you for listening, and this is probably going to be my last video for 2023, and I'll see you guys in 2024 on the other side where I'll be sharing my thoughts for the new year and what I think would be where we can focus on, where we need to be cautious about. I'll be having a live market outlook seminar in Singapore and Marina Bay Sands on the 20th of January. So if you happen to be in Singapore, you can get tickets, come down. If you want to fly from overseas to this live event, they'll be great. But don't worry, we'll have an online event as well. Till then, take care and may the markets be with you.